Well, good morning. This is Jagendra Rana. So, topic of the day is role of insurance in disaster management. Role of insurance in disaster management. Natural disasters often cause extensive damage to life and property. Disasters can have devastating and cascading negative financial impact on individuals, business, and economy as a whole. The rapid urbanization, environmental degradation, and an increasing number and intensity of climate changes are contributing to intensifying the disaster losses. Previous years witnessed to a large number of catastrophic events. Those hits various parts of the globe. According to Munich Re, more than 1,000 natural catastrophes were recorded in the year 2023. The overall losses totaled US dollar 190 billions, of which roughly US dollar 54 billion was insured, which in percentage terms is very less. So here's most devastating natural catastrophe were the earthquakes. So Asia, particularly the Indian subcontinent, is prone to various natural disasters like floods, cyclones, droughts, and earthquakes. The country has been a witness to a space natural calamities during the past 3 years. The Uttarakhand floods, Jammu and Kashmir floods, Hudud cyclone, and the recent Chennai floods have caused immense loss of life and property of individuals and have caused colossal damages to public infrastructure. At present, the statutory arrangement for disaster response in India is by way of two schemes which cover those disasters which are notified in the Disaster Management Act 2005. Disaster relief and rehabilitation is provided by the government through NDRF and SDRF are from the budgets set aside for such disaster relief. Both the funds are meant only for immediate relief and rehabilitations of affected persons and immediate repairs of damaged infrastructure. However, the funds required for the actual rehabilitation and restoration of affected infrastructure is far greater than what is available in the current funding mechanism. So the risk transfer mechanism achieving financial resilience is a critical component of effective disaster management. It is important to ensure that there is timely availability of resources for response, recovery and reconstruction in the event of a disaster. Therefore, evolution of an effective risk transfer mechanism to mitigate the risk arising out of the disaster is imperative. So the gap between the actual economic losses and the loss mitigation available can only be packed by using a combination of strategies for disaster risk reduction through risk financing and risk transfer. Insurance has been found as a viable alternative fund mechanism for governments in different parts of the world. A study of insurance schemes and practices prevailing in disaster prone countries have revealed that these insurances and the insurance mechanism have provided significant liquid funds to governments for immediate relief and rehabilitation in the event of natural disasters. So, as per the World Bank The availability of insurance offers the best mitigation approach against the real and fiscal consequences of disasters. Our studies estimates that approximately 80 to 90% of the economic cost of natural disasters in the developing world are uninsured. The uninsured proportion is significantly less in developed countries where there is greater insurance penetration. The uninsured losses in these countries generally fall in the range of 44% to 60%. While the insurance penetration in India is only 1%, which is significantly low. The actual economic loss on account of the Chennai floods was estimated to be around 25,000 crores, whereas the insured losses were accounted for approximately US dollar 755 million or INR 5,000 crores, which is around 20% of the total economic losses. So the economic loss because of cyclone Hudhud was approximately rupees 45,000 crores, with insured losses accounting for only about 10% of it. Similarly, during J&K floods in 2014, the state suffered a total loss of approximately rupees 5,000 crores. The insured losses were less than 10% of the economic losses. So, a huge gap have been observed between the actual economic loss and the insured losses. The proportion of insured losses is higher in Chennai floods as compared to the insured losses on account of Hudhud cyclone or Jammu and Kashmir floods. This evidently is on account of higher level of insurance penetration in metropolitan cities like Chennai and Mumbai as compared to other lesser developed as part of the country. So studies suggest that increased insurance penetration would lead to better insurance coverage and subsequently accelerate the process of recovery from the aftermath of the disaster. For the government, the insurance regulator and various other stakeholders are in the process of developing a suitable risk transfer mechanism so as to mitigate the risk arising out of the disasters. Various measures have been identified which can facilitate greater penetration and thereby build a robust risk transfer mechanism. There are certain suggested measures like increasing awareness among the masses about insuring their assets against possible losses on account of natural disasters. This can be achieved by way of preparation of simple literature and making it available to the general public, introduction of modules and sessions which cover subjects like disaster management and the importance of insurance. The mandatory insurance of public infrastructure, critical infrastructure and public utilities like airports, railways, ports, etc. Development of affordable standalone catastrophe insurance products including parametric insurance solutions covering risks like earthquakes and cyclones. State-sponsored or subsidized insurance covers for the life and property of the masses belonging to the BPL segment. Mass insurance schemes for protection of agriculture sector against the onslaught of disasters. Then focused research and studies on various aspects of risk transfer mechanism and disaster management. For the implementation of our measures requires concerned efforts on the part of the central government, various state governments, regulatory bodies, insurance companies, educational institutions and various other stakeholders. Implementation of the above cited measures would definitely help in increasing insurance penetration in the country. These measures would facilitate in mitigation of the hardship of masses affected by disasters and would thereby ultimately contribute to the long-term financial stability of the economy. So you see, the role of insurance and disaster management is most significant. because natural disasters often cause extensive damage to life and property, and disasters can have devastating and cascading negative financial impact on individuals, businesses, and the economy as a whole. So, rapid urbanization, environmental degradation, and increasing number and intensity of climate changes and contributes to intensifying the disaster losses. So the insurance can play a leading role in the disaster management. Because of the insurance, the catastrophes and the natural calamities can be covered, and to a great extent, the economy can be saved. Thank you very much.